Most people think earnings are about revenue and profit. They're not. They're about perception. And when perception breaks, even great numbers can trigger a sell-off. Wall Street doesn't trade on truth. It trades on fear. It trades on headlines. It trades on what the spreadsheet says at a glance, not what's actually happening under the hood. Meta's numbers looked like a disaster. GAAP earnings collapsed 83%. Investors ran for the exits, and the stock dropped 11%. But that's not the real story. I've been watching this name closely for months, and I was planning to break it all down this weekend. But the reaction to this earnings report was so irrational, so misunderstood, I dropped everything and made this video early. Because I believe this is a rare setup, a short-term headline panic misread by the market that created a window for real investors. And I want you to see it before the story changes. Nobody knows how the stock will trade today, but I wouldn't be surprised if it starts recovering immediately, because what you're about to see changes everything. Let's close the gap between what people think happened and what actually did. Meta's AI ad engine is a $60 billion cash machine. You don't build a $60 billion ad engine by average. You build it by knowing your customer better than anyone else, and then letting AI do the rest. Meta's ad revenue jumped 25% year over year. Price per ad up 10%. Impressions up 14%. Reels now has a $50 billion revenue run rate. That's not potential, that's production. They're not hoping AI will pay off. It's already delivering. Their ad system gets smarter with every impression. More relevant, more profitable, more unstoppable. While everyone else is still pitching vision, Meta is shipping dollars, billions of them. This is what AI looks like when it's actually making money, not burning it. Meta doesn't just have scale. They've got the feed, the infrastructure, and the flywheel. And that's what separates a business from a machine. Meta delivered $40 billion in revenue. Ad growth hit 25%. Free cash flow was over $10 billion. On every core metric, this was a dominant quarter. So why did the stock drop 11%? Because the headline number showed a profit collapse. GAAP net income dropped 83%. Earnings per share fell from $5.33 to $1.05. That's all most people saw. But what caused it wasn't a loss. It wasn't weakness. It was a one-time non-cash tax charge of $15.93 billion. Meta had to remove future tax credits from its books because of new federal accounting laws. They didn't lose $16 billion. They didn't spend it. It was a paper adjustment. The real business didn't change at all. That one line spooked the market. It made the entire report look broken. But once you strip it out, this might have been one of the company's strongest quarters in years. That's the difference between understanding numbers and reacting to them. Most investors never look past the surface. That's why most of them lose. The $15.93 billion tax hit. Meta just reported one of its best operating quarters in years, but on paper, profit dropped 83%. Most people panicked. They thought something broke. It didn't. What happened was accounting. Not failure, not fraud, just a tax rule that triggered a one-time $15.93 billion expense that caught everyone off guard. This wasn't cash leaving the bank. This wasn't a fine. This was Meta being forced to write down tax credits it had been carrying forward. Overnight, the government decided they couldn't use them anymore. Think of it like this. Imagine Meta had a $16 billion gift card for future taxes. Then Congress stepped in and said, you're not allowed to spend that anymore. The money never left their account, but the value disappeared from the balance sheet. That's why GAAP net income collapsed. Not because the business stopped working, but because the tax write-off tanked the reported number. It made $7.25 of real earnings look like $1.05. And that's what everyone missed. The business didn't slow down, it accelerated, but the headlines told a different story, and that's all most investors ever read. This tax hit was a one-time event. It's not recurring, it's not a signal of weakness. If anything, it lowers Meta's cash taxes moving forward. But because it wasn't telegraphed, it spooked analysts. It made people question the numbers, and when investors feel uncertain, they sell. That's why the stock dropped 11%. Not because the quarter was bad, but because one accounting line made it look that way. You have to dig deeper, because if you don't, the market will rob you blind, and you'll thank it for the favor. The bull case is getting stronger every quarter. Meta isn't just winning, they're pulling away, and every quarter, the gap gets wider. AI is no longer just a buzzword for Meta. It's a working product, and it's printing. They're running at a $60 billion annual ad run rate powered by AI. Reels alone is pacing over $50 billion. Instagram video time is up 30%. That's not soft growth. That's a platform scaling with precision. They added 42% more capital expenditure this quarter, not for fun, for compute, for infrastructure, for models that sharpen ads, train AI, and automate billions in commerce. And with that spend, free cash flow still came in at $10.6 billion. That's not luck, that's a machine that gets smarter, more efficient, and more profitable with each new input. And while others are just starting to monetize AI, Meta already has product market fit. Their AI tools drive real conversions. Their ad engine is monetizing at full speed. They're using AI to drive both reach and return, and it's working. This isn't a pivot story, it's a compounding advantage, and the numbers prove it. Now the bear case and the real risks no one talks about. Most people only talk about upside, but the risk is what actually costs you money, and this stock still has risk. Start with margins. On paper, Meta looks profitable, but once you factor in debt service, share repurchases, and capital expenditures, the free cash flow margin softens. The levered free cash flow margin sits at 28%. That's good, but not untouchable. They're also spending heavily. $8 billion to $10 billion per quarter in capital expenditures going forward. If revenue growth slows, that spend starts to squeeze. And if AI monetization stalls, Meta becomes a growth story without growth. Another issue, the market doesn't trust unexpected surprises. The $15.93 billion tax charge was non-cash, but it was also a surprise. That rattled analysts. If Meta misses tone again, it could damage investor confidence longer term. There's also the competitive threat. TikTok's not going away, YouTube is getting better at shorts, and Meta's AI lead is real, but it's not a monopoly. And then there's the elephant in the room, regulation. One antitrust ruling, one privacy shift, or one political turn could knock billions off the table. That's not theoretical, it's happened before. This is still a high-risk, high-reward stock, and if you're going to bet on it, you need to treat it that way. Position size small, expect volatility, and know what you're actually betting on. So is Meta a good long-term investment? Most people wait for a stock to feel safe before they buy. By the time it feels safe, the upside is gone. Meta just printed $10.6 billion in free cash flow in one quarter. They're throwing off $40 billion a year in operating cash. They've got $44.4 billion sitting on the balance sheet, and they're spending it with intent. Infrastructure, buybacks, dividends, compute. That's not a bet. That's a cash machine scaling on rails. Everyone got scared because of one line, a $15.93 billion non-cash tax adjustment. Not a loss, not an expense, just the IRS saying you can't use those credits anymore. It didn't hit cash, it didn't change operations, but it tanked optics. And because most investors don't read, they sold. Not because the business broke, because they didn't know what they were looking at. This is how the market hands you opportunity, not with good news, with confusion. The product is working, the ad engine is scaling, the AI flywheel is spinning, and the business is fully funded with zero reliance on hype, debt, or dilution. What more do you need? I'm not here to convince anyone. I've seen the numbers, I understand the game, and I'm betting on execution. You can wait for clarity, you can wait for approval, or you can buy when everyone else is misreading the score. It's your call. What I'm doing right now, I see this as a buying window. I don't chase headlines, I chase cash flow, product traction, and execution. And based on everything I've seen, this sell-off is a gift. Meta just dropped 11% on optics, but under the hood, revenue is up 26%, free cash flow over $10.6 billion, AI performance improving, and the balance sheet stacked with $44.4 billion in dry powder. This wasn't a bad quarter. It was one of the best quarters in company history, disguised by a single tax adjustment. And that's why this is a buying window, not because it's cheap, because it's mispriced. The business is getting stronger every quarter. The numbers are trending up across revenue, product usage, and free cash flow. The product is becoming harder to compete with, not easier. That's what I look for, and that's what I bet on. So yes, my thesis on Meta is bullish, and the 11% dip, that's not a red flag, that's opportunity. But let's be clear, this is still a stock. It can crash, it can swing 10% in a day. That's the risk. That's why I size positions with discipline, and why I only bet big when I understand the story behind the numbers. And right now, I understand Meta, and this window looks wide open. So let me ask you something. Who else is breaking down Meta's $16 billion tax adjustment, explaining the real story behind the 11% dip, and showing you how to position around it while actually managing seven-figure positions in real time? Who else gives you the bull case, the bear case, and the roadmap to act with conviction without pretending to know the future? Nobody. That's why my portfolio was up over $2.86 million this year, 82.17% year to date, and it's only October. And it's not just me. John Bruce had $135,000 going nowhere in July of 2023. Now his account is just shy of $700,000. His words, not mine. From all appearances, I'm going to be a millionaire next year. It's real. Wreaks Havoc pulled $10,080 off a Palantir trade and called it not a bad morning. Steve booked $1,760 in profits and said, a take profits day for me. This isn't theory. This is what consistent real-world execution looks like. Inside my Patreon, you get real-time trade alerts with full breakdowns, entries, exits, and the why behind every move. Daily market analysis, no fluff, just what matters. And the exact momentum strategy I use to scale seven-figure positions with discipline. Plus, access to the most execution-focused community of investors I've ever seen. It's only $30 a month, and that's nothing when you see what it's doing for people. So instead of blowing $30 on bullshit, put $30 into something that could actually make you better. And if you don't 3x your investment in yourself, cancel it anytime. You've got two options right now. You can scroll or you can scale. But either way, don't say you weren't told.